All right, let's get right into it. What we're about to cover, this isn't just another trading strategy or some new entry signal. I want you to think of this as a complete upgrade to your mental software. We're going to strip out some of that old retail logic and replace it with how institutions actually read the market structure. So let me ask you this. Have you ever been in a trade, felt great about it, and then bam, you get stopped out by some crazy sudden spike, only to watch just moments later as the price reverses and rockets exactly where you knew it would go? Yeah, it's a feeling just about every trader on the planet knows well. Well, guess what? That feeling you get, it's not in your head. The market is hunting for something. But here's the key. It's not hunting for you. It's not personal. What it's really hunting for is liquidity. And your stop loss just happens to be sitting right in that pool. Getting this is the first real step to thinking like a pro.
You know, the biggest issue for so many traders isn't a bad strategy. It's a fundamental misunderstanding of how the market is built. The trap is looking at a chart and assuming that every peak and every valley, every single swing high and swing low means the same thing. They absolutely do not.
So, why does this matter so much? Because when you get this right, it stops you from getting into trades at the worst possible moment. It's the difference between trying to fight the river and actually reading the map of its currents. You finally start to see why price makes those shocking moves, because you can see the institutional footprints all over the chart.
Okay, so let's get to the heart of it. This is the one core distinction that changes absolutely everything. Not all price swings are created equal. The market builds two kinds of swings, strong ones and weak ones. And believe me, institutions treat them completely differently. Learning to see this difference, well, that's your new foundation.
First, let's just get the boring textbook definition out of the way. A swing high is a peak with lower highs next to it. A swing low is a valley with higher lows next to it. Right, simple. But here's the problem. That definition tells us absolutely nothing about the quality or the meaning behind that swing. And here's where it all comes to life. A strong swing, it shows pure conviction. It moves with force, with authority. It creates real displacement you can see on the chart. It's a confirmation of structure. A weak swing, though, that's just exploration. It's kind of shallow, it feels uncertain, and you'll see it get retested over and over again. You see, one is a statement, the other is a question.
So why? Why does this difference even exist in the first place? It all comes down to the one thing that drives big institutions, their constant, relentless hunt for liquidity. They can't just click a button and buy $1 billion worth of something like a retail trader. They have to find massive pools of orders to fill their positions.
And let's be crystal clear on what we mean by liquidity. Just picture an ocean of buy and sell orders sitting at all these different price levels. If an institution wants to buy, they need to find sellers, a lot of sellers. And where do they find them? At these key swing points. So here it is. This is the crucial takeaway. These swing types are basically footprints in the sand. A strong swing is a big, deep footprint showing you exactly where an institution found a ton of liquidity and caused a powerful reversal. A weak swing? That shows you they're still searching. The orders weren't there, so price just keeps poking around that area.
I mean, just think about the logic here for a second. If an institution builds a massive short position at a swing high, what's the last thing on earth they want to happen? For price to come right back up. That would put their entire trade in jeopardy. So a strong swing, by definition, has to be defended. They push price away from it with force.
Okay, that's enough theory. Theory's great, but seeing is believing. Let's jump onto the charts and see what these footprints actually look like in the wild, because this is where it all starts to click. Okay, look at this right here. A perfect example of a strong swing high. Price pushes up, it forms a nice clean peak, and then boom, look at that rejection. It just falls off a cliff with these big, powerful down candles. And here's the most important part. Look at the space it creates. Price doesn't even think about challenging that high again anytime soon. That is a footprint of conviction. The structure has shifted. Now, let's contrast that with this. A weak swing high. See that big, long wick sticking out the top? That's your first clue. It shows price tried to go higher, but it got pushed down without any real power behind it. And then, what happens next? Price comes right back to test that level, again and again. This isn't a structural point. It's just a messy zone of exploration.
And hey, the exact same logic works for lows. Look at this beautiful strong swing low. Price comes down, carves out a very clear bottom, and then it just launches upward with real power, real displacement. It moves away with authority and doesn't look back. That is telling you that institutional buyers stepped in right there, soaked up all the selling and took firm control.
So this is where the mistake happens. This is the trap. A trader sees a weak swing forming, like that messy one we just saw, and they immediately jump in short thinking the top is in. They put their stop loss just above it. But remember, that swing was weak. So price comes back up to hunt for more liquidity, it triggers their stop, and then it makes the real move down. Their stop loss literally became the fuel for the institutional trade.
So how do you avoid falling into that trap? You need a new mental checklist. You have to stop reacting to every little price movement and start analyzing the structure with an institutional mindset.
Here it is, your new litmus test. Before you trust any swing point, you run it through these 4 questions. 1. Was there real displacement? Did price move with conviction? 2. Was the rejection sharp and authoritative? 3. Did price create distance and stay away? And 4. Did the move actually lead to a real break in market structure? If you can't say a firm yes to these, you wait.
And let's just put them side by side to make it dead simple. The movement, strong swings are sharp, weak ones are shallow. The candle wicks, strong swings have minimal wicks, weak ones often have really long ones. And the retest, a strong swing doesn't get retested right away. A weak one almost always does. One means the structure has changed. The other means the market is still just figuring things out.
You know, all of this brings us to what might be the single most important mindset shift you can make as a trader. In a world that screams about moving fast, institutional thinking requires patience. Waiting for a swing to prove itself, to show you that conviction and displacement, that's not a weakness. It's not missing out. It is your single greatest strategic edge.
So let's just quickly recap the absolute must-knows. Number 1, not all swings are created equal. 2, strong swings show you where institutions have committed. 3, weak swings show you where they're still exploring. Your job? Use the strong swings to build your map of the market's framework, and then have the discipline to wait for the structure to prove itself to you. So now that you know how to tell the difference between a strong and a weak swing, the next big question is, what happens when one of those strong points finally breaks? Well, in our next explainer, we're going to dive deep into what a break of structure really means to an institution, and I'll give you a hint, it's probably not what you've been taught.
So I'll leave you with one last question to think about the next time you open up a chart. Are you just reacting to every candle, every little up and down tick of the price? Or are you taking a step back, identifying the true structural points, and actually reading the story the market is telling you? I promise you, the answer to that question will change everything.